the most common methodology for kind of determining position size is based on the risk you want to take on a trade. And if you read any kind of trading books, you'll see, like you should never risk more than, say, 1% of your trading portfolio on any one trade. And I've seen 2%. Some people will trade as much as 5%, but whatever risk level you're comfortable with, that's what you would kind of set your risk limit at. So, and I always kind of tend to go towards the lower end, 1 or 2%. But in this example, if your trading account was $50,000 and you said, I only want to risk 1% on any one trade, then you would set it up so that your max loss would be $500 on a $50,000 account. And you can, and I'll show you a spreadsheet that I added to our joint spreadsheet that helps you calculate this. So just as a quick example, if you had a $50,000 account and you had a 1% risk per trade, and you traded a $5 wide SPX trade, you would only trade one contract. So that would be the most you could lose. You actually would lose less than 1%, but you don't want to go over that amount. And the other thing is that I think is pretty important is you can adjust your percentage based on whatever strategy. So for example, if you say the SPX put spread, I want to risk 2%. And on the in the money trade, I only want to risk 1%. So you can, mix and match based on your calculations. The position size is really an essential piece of any trading plan, because you want to, when you are building out a trading plan, you want to say, okay, I'm my business, my trading business has X amount of dollars. And it doesn't really matter what that number is, as long as you kind of have that as your trading capital. And then you want to determine, what strategies do you want to use with this amount of money? Now you could trade this strategy, you could buy other stuff in addition to this strategy, but you want to allocate a certain amount for this particular overall strategy. And so you could have, 5 different trades that you're doing, but you want to kind of segregate them in terms of your trading plan. And then, the key question is, how much are we allocating to each trade based on your trading plan? And it also affects your exit rules, because if you actually have a trade that you have a risk of, say, $1,000, but your exit says I'm not risking more than 500 in a trade, then you have to get out at the 500 level. So those are kind of the why it's important to have that as part of your trading plan. And it doesn't have to be complicated. It can be simple, and I'll show you a couple of different versions that you can use. Any questions so far? Make sense so far?